This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, was great to have Alex back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to the chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Now, just go to our homepage, MacroVoices.com, click on the red button over Alex's picture saying, looking for the downloads. Now, Eric, let's get to crude oil.
EIA inventory was delayed by the holiday this week, but API, that's the private service that reports the day before, normally on Tuesday afternoon, and of course this week would be on Wednesday afternoon, API reported an utterly massive build of 13 million barrels of crude oil. That's obviously a very large build and would be significant if confirmed by EIA. But since we don't have EIA inventory this week due to the holiday, I'm going to comment on the developing situation in Israel and the Gaza Strip instead. This is, I would say, the second biggest variant perception event for me in my entire career. The only time that my feeling that I was very much out of sync with the market and disagreed strongly with what most market participants were doing was February of 2020. After we had a January 30th, 2020 is when we told you to expect a global pandemic, and February was the month where everybody just shrugged it off and ignored it, and I had to question myself. Am I getting this wrong? What the heck is going on? I couldn't believe it. I was shocked this week to read a couple of different commentaries, and these are from professional analysts who ought to know what they're talking about. And the sentiment was essentially, okay, well, now that the fears of geopolitical escalation in Israel have pretty much blown over, oil is predictably correcting lower. They think this is over? Look, the Pentagon has already redirected the movements of aircraft carrier battle groups. This is anything but over. With at least 22 Americans confirmed dead as of Wednesday afternoon, we're following U.S. retaliation standard operating procedures to the letter. They're always completely silent about any intention of military retaliation until after the bombs have already landed. So if the U.S. intends to retaliate directly against Hamas, which is very likely considering the extent of American casualties, we won't find out about it until after it happens. Meanwhile, the Israeli escalation has been extraordinary, with more promised from Netanyahu. But more to the point, the real risk here is of a broader escalation of this conflict. As Alex said in the feature interview, there is no systemically important oil supply in Israel or Gaza. The most immediate risk is for some warmongering U.S. senator to start calling for airstrikes on Iranian oil fields because Iran reportedly helped to plan this attack. And, of course, Lindsey Graham won't miss any opportunity to call for another war. So he's already argued for doing exactly that. Meanwhile, presidential candidate Nikki Haley made even more incendiary comments that are certain to increase tensions between the United States and most of the Arab world. Before this event, Saudi Arabia and Israel were working to normalize diplomatic relations, and this clearly isn't going to help. So the risk of geopolitical escalation reversing this sell-off in crude oil remains extremely high. Whether, how, and to what extent the U.S. military joins Israel in a counterstrike against Hamas will be what determines how far this conflict spreads across the region. And that's a matter of when it happens, not whether it's going to happen. Aircraft carrier battle groups and guided missile cruisers have been redirected to the region. These are not the vehicles preferred by diplomats and peacemakers. Bottom line, this ain't over till it's over, and my sense is that this is still the calm before the storm. Obviously, Israel's response has been extraordinary, I would say unprecedented in its magnitude. I don't even think that's the worst of it. I think the U.S. is probably about to join in, and I think this is going to escalate into regional conflict. The risk to the oil market in terms of upside price risk is extraordinary. Now, there is still, of course, the recession risk, and with all these big big builds in crude oil and finished products, okay, there is definitely a bearish argument if the geopolitical situation somehow magically just blew over and got forgotten about. That's not likely to happen, folks. I think the skew is definitely to the upside in terms of risk. Remember those 100-strike calls on March 24 crude oil futures that I mentioned in last week's report? Well, they've more than doubled in price from the 66 cents they bottomed at, despite that the flat price has remained approximately the same. The reason is that oil volatility is back, and the market knows the upside tail risk is all too real. So I think that just like COVID, I'm going to be called a lunatic conspiracy theorist for focusing on the upside risk until the market wakes up to what should already be painfully obvious. A really big conflict just started in addition to the Ukraine conflict, and it could easily spread across the region. $150 oil is entirely possible, and risk is definitely skewed to the upside. The gap on the WTI chart has now been filled with this sell-off we had on Wednesday, and a daily close over the 34-day moving average at 86.79 is the next signal I'm watching for as confirmation that the bull move is back on. But I don't think it's really going to be back on in earnest until more people wake up to what seems obvious to me, which is this situation that's just erupted geopolitically is not over, and it's going to get worse before it gets better.
Yeah, Eric, I'm looking at this chart on oil. I mean, we had an amazing run from just under $70 all the way north of $90 in a span of just 2 months. And after such an advance, typically the rallies get checked, and some of these inventory builds and things like this certainly became a catalyst. But now, obviously, with the geopolitics, there's big variables into what technically can emerge. I really look at it that the backdrop can still be bullish on oil on the interim, and one of the things that I'll be looking for is whether or not we can beat from the highs from earlier this week, and see whether or not we can progress toward $90. If we start clearing and showing the sequence of higher highs and higher lows, staying above all the moving averages, that may mean that the next window is open for an advance that could even go up to $100. Overall, while certainly a recession could spur a sell cycle and a reversion, I think when you look at with the way the economic data is rolling in here, I think that a recession is not yet confirmed, and so therefore oil may surprise everyone still with some further upside before pulling back any further. All right, let's move on here. I want to get Nick into this conversation. Nick, on page 3, we have the S&P 500. What are the option levels you're looking at here?
Yeah, Patrick. So the current spot price of SPX is around 43.80. We have a call wall just above at 4,400, which also acts as key resistance, and a put wall below at 4,300, which acts as key support. Now, the implied move for the October 20th OPEX, which is for next Friday, which is also a very key OPEX, is plus minus 80 points, which denotes a potential move to the upside of around 44.60 and a potential move to the downside of around 4,300, right near that support area that I just mentioned. As I mentioned last week, I thought we'd see a pop off those lows toward the 4,350, 4,400 area. We're there right now. I don't see much more upside in the short term, but I could be wrong, obviously. I think we perhaps consolidate around here and then hit new lows over the next few months or so. What are your thoughts, Patrick?
In principle, I agree with you, but we showed last week's charts just how incredibly oversold the market was, and either it was going to be a capitulating washout or just like a elastic band stretched too far between two fingers. It's going to snap a little bit the other way, and so we had that reflexive rally to unwind the oversold state of the market. The interesting thing is that the dynamic hasn't changed. We see relative strength in the Mag 7 and the NASDAQ, and we see relative weakness in the small caps and the equal weight indices, and things like consumer defensive names and things like this have all just continued to do incredibly poorly. And so the dynamic hasn't changed. And so as we now have reached these retracement zones, this is an area where if this sell-off is not over, this is where some short-term highs can develop. To me, a breakdown back down below 4,300 on the S&P futures on page 4 is what I would be looking as indications that potential another round of selling may have gotten underway. Nick, though, let's talk about the NASDAQ, which again, like I was saying, has shown a little bit of relative strength compared to the S&P 500. What levels are you watching and what are you thinking here?
Spot price right now on Qs is 372 approximately. We have a call wall above at 380 and a put wall below at 360. The implied move for the October 20th OPEX is plus minus 8 points, where the upper expected move is right to 380, which is that call wall, also acting as resistance too. And then below we have an expected move of 364 approximately. Support is at 360, then 355. Again, tech really has dictated the moves in the market overall because we've seen the Mag 7 essentially take charge to the upside or downside overall. Right now we're seeing a number of the large names back near their all-time highs, and that potentially denotes that we may have trouble pushing higher. But again, if we do break through key resistance areas, like if we get above 380, for example, we're only an earshot away from all-time highs at 408 roughly. So it's possible we get up there. I don't think it's going to happen, but that's my opinion right there.
Well, it's interesting. Like it would literally, it's Meta and Google that are the ones that just punched to a fresh new high. So some of the other Mag 7 are strengthening, but they're not. They don't have that same momentum. But it just continues to demonstrate that the breadth of the market continues to narrow. And while maybe a bull impulse on these might be enough to cause the stock market, like on the Qs, to go and double top, retest, or at least hit its September highs, I just don't know whether or not the market has the backdrop from which it's going to make a fresh new high this calendar year. Odds are the highs of the market are probably in for the year, but the bigger question is there a more ominous drop that develops this year, or is it a first quarter next year? Well, though on page 6 we have the VIX here, Nick, and what was interesting to me is that this entire sell-off where we gave back these 300-400 S&P points over the last month and change, we never saw volatility on any sustained basis get above 20. I mean, we stayed in the teens the whole time. Just while certainly there was a spike in volatility premium, it's certainly nothing that would typically be associated with a key swing bottom in a market for a sell-off of that magnitude. We're here at the 16 level. What are your thoughts here?
Yeah, so right now with the VIX at around 16, this denotes that we should have average daily moves in the broad markets of about 1%. We saw a spike back down from the 20 mark, again, because last Friday, when we were at around 42.20 on SPX, near the lows, we saw a lot of put premium selling out of the money. So that kind of suppressed demand for puts, I guess. And in that case, we saw also a counterbalance where we saw a lot of buying of calls on 0DTE, which drove us higher on Friday. We went from a low of 42.20 to a high of 43.25 approximately, which was also the second widest range we've seen all year on SPX, which is very interesting because, the straddle prices were very underpriced at only about 25 points on Friday. So I've noticed that over the past few days as well, the market's underpricing the moves by, based on the straddle price anyway. By watching the straddle price first thing in the morning, you're seeing that it's about 22 to 25 points. Meanwhile, we're getting a range of about 45 to 105 as of Friday, which means that if you just buy a straddle and you're directionally agnostic, you essentially win, right? Obviously, if it stays in the same spot, then you lose. But in the short term, what I'm seeing is a lot of premium selling out of the money. Now, this gamma pin may unwind after next Friday's OPEX because a lot of the options will roll off, and then that may kind of open up a window for more volatility ahead. Now, moving on to page 7, we have the US dollar index. What are your thoughts here?
The Dixie peaked at 107 and is trading on a low 105 handle early on Thursday morning. Does that mean the top is in, or is this just a brief pullback before the dollar rally powers higher past 107? And I think it's too early to tell, but at least the near-perfect straight-line ascent that we saw from early June through last week has finally been broken. Let's see what next week brings.
Yeah, the overbought state of the dollar, Eric, has created a bit of a pullback. But one of the technical things that we look for is back in March and in the summer in June, the dollar put in highs and resistance at 104, 105. So now that we've cleared all of those major highs and are now approaching them, it often becomes support. And that's convenient that the 50-day moving average lies there. I think we can easily go down still and test even 105 or 104.50 on the pullback. But my first inclination is that will be a buy on dip and send the dollar right back to its highs. But the question is that going to last for the rest of October, or is it a quick dip that lasts just a few days? I'm in the buy on dip mode on this with a little bit of room for further weakness. So I'm looking for a little bit lower prices for the next buy.
Moving on to page 8, we have the gold futures chart. Eric, what are your thoughts here?
Gold was badly oversold before the Israel-Gaza event this past weekend, so the timing was perfect for this conflict to serve as a catalyst for an upside reversal. But now the question is whether it will last, because what we've seen in this gold market is that for the last couple of years, geopolitical events have caused spikes in gold that generally haven't lasted, even as the geopolitical event did last. So when we had the outbreak of the Ukraine war, there was a big spike up in gold, but even as that conflict kind of escalated over time, gold came back down. If we look at Treasury yields and if they continue to surge higher, as a lot of people are predicting, it spells a bearish argument for gold. Meanwhile, just in the last few days or last few sessions, we've come back off of that oversold condition to not yet an overbought condition, but coming, back up to the top of the range here on the slow stochastics. We're also right on the 21 and approaching the 34-day moving averages, which would be likely reversal points. So I think there is an argument, despite the fact that it makes no sense to me, because I think gold should be much higher on both the expectation that we will eventually see the force of a dovish pivot from the Fed, but also on the expectation of growing geopolitical tension. So I think gold ought to be much higher, but if I look at what's happened the last few times, I thought that we got a bounce on the geopolitical event, then it rolled back over. So the rollback over point ought to be right around 1900 or so, just above 1900. Let's see what happens.
Yeah, Eric, when you're saying question whether it lasts, to me, it's obvious a bit of geopolitics, but really it's the dollar pullback that has allowed gold to have a chance to revert and take a breather from that heavy selling. As we approach this 1900 to 1920 area, I have that 50-day moving average on that chart. It's a place where if there is going to be more selling in gold, this would act as a key overhead resistance. I, in the bigger picture, am quite bullish gold, but this is not the stage of the cycle where gold should be bulling yet. And so my first kind of call on this is that it's going to bump its head here, and whether it has only a marginal further downside risk, I still think the opportunity to really load up on gold is at some point later this quarter, if not in the first quarter of next year. I'll be looking for that buy on dip, but I'm going to be a little patient on it. The last thing I wanted to touch on, though, on page 9, I have the CME watch tool looking at what is the probability of a rate hike now going into the November 1st Fed meeting. And that has now dropped to 11%, better than an 88% chance that the Fed remains unchanged, as there's now slowly talk that the Fed may actually pause as financial conditions have tightened sufficiently. It will be interesting to see whether or not this continues to materialize and whether or not that indicates that we're very close to a pivot or maybe months away from a pivot. And that's where on page 10, I want to watch that 2-year note futures. And you can see there's been nothing but relentless selling as the Fed has been raising rates and the 2-year yield has cleared 5%. But the downside momentum has stalled, and it's really creating a bit of a basing formation. And if the market really starts to sniff out that there might be a new easing cycle at some point in the future, or at least even if the Fed is done, it'll be really interesting to see whether or not we start seeing new bullish price action here, which, by the way, on this chart has not appeared yet. And so this is just one of those things that I'm watching closely because I think there might be an interesting opportunity that develops there.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.